Okay guys, today we're going to be going through how to play the final inning of the bull market, what you should be doing, and the step-by-step checklist process for you to make the most amount of money and also to avoid risk of ruin in this final leg. We're going to go through it. I'm going to hold your hand. We're going to go through it in painstaking detail. So, crypto bull market endgame, the final innings playbook, contents. Cycle positioning and late stage market dynamics, late stage hopium, FOMO traps, repricing stables as strategic ammunition, the laddered exit framework capturing the final eighth, narrative hunting and playing the game, surviving the winter, bear market conditioning, gonna get you guys ready, and cycle endgame checklist. Let's get going. Cycle positioning and late stage dynamics, the final blow off top. Bitcoin has followed the same rhythm for all of the cycle. Long consolidations, then explosive breakouts. Each leg has been shorter and sharper than the last. So it started very small. I got a diagram here you can have a look. So this is on the monthly chart. Each bar is 1 month. You can see in the green bubbles that the green bubbles indicate consolidations. The percents that I have here are the percents that it went up from the bottom of the consolidation to the top of the next one. So this first leg was 122% up. The next one was 67. I'm expecting the next one from now to be around 40%. That's going to take us to around 140, 150K Bitcoin. That would line up. So this is the last parabolic run before the top. And if you're thinking this can run forever and we're going to get a super cycle, you're setting yourself up to be exit liquidity. Volatility expansion, the rallies accelerate, but so do the pullbacks. Gains that took months earlier now play out in weeks and can just unwind as fast. If you're complacent, the market's going to take back everything. So discipline isn't optional anymore. It's necessary for success. The risk curve cascade. Bitcoin leads the move, but its rally leads to other coins running. So when Bitcoin runs, liquidity spills into ETH, and then it rotates into Sol and Sui, and then meme coins. This rotation creates the illusion that everything only goes up, but this is actually, if you're smart and switched on, it's one of the clearest signals of a late stage cycle, but also a signal that traders can capitalize on if they're smart. Asymmetry shift. In the early stages of the bull cycle, the upside is far greater than the downside. Later in the cycle, this inverts. So every leg higher becomes exponentially larger potential drawdown. Traders must manage their risk as they get further into the cycle, while retail continues to size up risk. And at the exact moment that asymmetry deteriorates, which is right at the top, most people increase their risk at the top of the market, and that's the most dangerous time to be increasing your risk. The knife's edge. The final inning is simultaneously the most dangerous and the most profitable stage of the market. This is the window where disciplined traders can change their net worth dramatically, but also where overexposed players lose years of progress within a matter of weeks. The difference comes down to whether you treat this as a battlefield with a plan or a casino with chips. Let's move on. Late stage hopium and FOMO traps. The super cycle mirage. At the very top, the same surface always resurfaces, the same narrative. This time it's going to be different. Analysts claim that Bitcoin will break the 4-year cycles, and I believe it will eventually, but for this cycle, we're still going to get a bear market. It's pure delusion. It's designed to keep you holding while insiders and smart retail dump on you. Exit liquidity dynamics. Parabolic coins that have already moved 5 to 10x create irresistible FOMO. Retail justifies entries at these inflated levels by anchoring to recent price action. But every parabola requires liquidity at the top. And those who chase are not buying opportunities. They're supplying exits to smarter traders and investors. That's what you've got to be careful of. A signal of excess, celebrity coins. When tokens tied to politicians, influencers, or celebrities dominate headlines, it feels like mainstream adoption, but in reality, it's a late-stage symptom of late-stage euphoria. We saw this back in January 2025 when Trump launched his meme coins and all the celebrities were launching meme coins. That created the local top. You got to watch for that. Narrative capture. Late in the cycle, bullish rationalizations dominate. They are rationalizations. People say super cycle, digital gold, ETFs, AI integration, institutional flows. While these narratives might be true in the long term, their late stage cycle is purely psychological. They're suppressing risk awareness and justifying overexposure at the worst possible time in the markets because they need to make money from you. Don't you understand that the big banks, Goldman Sachs and BlackRock, these banks need to make money off someone. So they will post all these bullish things, all the KOLs will post all of their bullish things, and they'll make you hold and become exit liquidity. The greater fall theory. As euphoria peaks, communities polarize. Online echo chambers reward aggressive bullishness and punish caution, creating social pressure to hold when it's the highest risk. This is exactly what happens on crypto Twitter every time. The dynamic ensures that the majority remain locked in and are unable to exit when the reversal inevitably comes. And this is exactly why it's the hardest thing to sell a top and the easiest thing to sell a bottom. The game is literally rigged in this way, like I just told you. So, you have to reprice stables. When I say stables, I mean USDC, USDT, as strategic ammunition. Capital as ammunition. In the late stage cycles, stables should no longer be viewed as sidelined capital. They are live ammunition. Dry powder that compounds its power the longer you hold it. Every dollar held near the top multiplies when redeployed at the bottom. You should mentally be viewing 100K in stables at the bottom as having 10x the buying power it had at the top. Does that make sense? 100K at the top buys 100K of assets. You should mentally be thinking at 100K at the bottom buys 1 million of assets. Stable coins are worth more at the top of the market. I know that sounds crazy, and tokens are worthless. Whereas stable coins are worthless at the bottom of the market and tokens are valuable at the bottom of the market. You have to invert your thinking. The traders who treat stables as precious assets at the top are the ones who win long term. So the key psychological reframe is you need to treat, a lot of retail treat stables as weakness, as missing out, wasting opportunity. You have to flip the script. Holding stables is not inaction, it's an active position. Okay? They are a position that gives you the freedom to dictate terms when the market resets. And liquidity in the bear, they give you opportunity to buy heavily in the bear market. And the bear market's wealth transfers from the impatient to the patient. They allow you to step in, stables allow you to step in as forced sellers capitulate, buying assets at huge discounts. The best trades of the next cycle are made in discipline and the courage of holding stables at the top. Hold those stables right at the top when everyone's telling you you're crazy. The laddered exit framework, capturing the final eighth. Exit into strength. Tops are only obvious once they've happened. If you wait for certainty, you give back gains. No one ever sells the exact top, so scale out as price moves higher. Sell into strength while momentum is up, not after the reversal. The final eighth rule. The last leg of the cycle, the final eighth, has the largest volatility. It means you have the most opportunity to make the most amount of money, but the most opportunity to also lose it. So the goal is to extract life-changing upside while ensuring that when the music stops, you're largely in stables and risk off. This is what we spoke about before. Moon bag psychology. You don't have to sell 100% of your bag. Keep a moon bag. A small position is a good idea. This small position allows you to ride further upside if the market overshoots while managing your risk. And also, and finally, survival over perfection. Most retail dreams of selling the peak top. The best traders and investors optimize for survival. The objective is not to be right to the exact tick, but to be liquid, disciplined, and positioned with enough dry powder for the next cycle. Let's move on. Narrative hunting and playing the game. The meta game. Late in the cycle, the biggest returns don't come from fundamentals, but from narratives. The market becomes a battleground of stories, new chains, celebrity tokens, AI integrations, meme coin rotations. Those who identify and rotate into these narratives early capture the upside and get rich, while those who don't get left behind. You got to follow the logic, follow the flow, not the logic. So At this stage in the market, valuation models and long-term fundamentals completely fly out of the window. That's something for bear markets. What happens and what's important is where the attention is flowing, where the liquidity is flowing. The best traders play narratives hard, knowing the edge comes from timing and positioning, not rational analysis. Early narrative recognition. The biggest gains come from spotting narratives before they become adopted. The signs are subtle. Developers quietly building, momentum, KOLs hinting at a new meta, unusual wallet activity, small communities rallying around an idea. Good traders scan Twitter, Telegram, and on-chain flows daily, not to follow hype, but to detect these signals before they explode. So the play is simple. Enter small, the narrative is niche, and size up when you start to build your own conviction, and rotate out when you feel that a narrative is saturated and everyone that will buy has bought. With a Trump meme coin, who was left to buy? My grandma? My grandma doesn't even know how to use a computer. There's no one left to buy that Trump meme coin, therefore the market's topped for that meme coin. Okay? So that's a mental model you have to implement. You have to exit as the crowd enters, like I just said. Narratives are self-reinforcing on the way up and destructive on the way down. The goal is to rotate in while the narrative is niche and rotate out while it hits larger attention. When every large KOL on CT is echoing the same narrative, you're probably late. And you have to be aggressive with a defensive core. Narrative hunting is offensive, fast, aggressive, high conviction rotation. But it must be balanced with defense. Secured profit, stable reserves, a clear ladder. Traders can only play the game at full intensity because they have protected themselves already from complete ruin. So, surviving the winter, the bear market conditioning, the irreversible mean reversion, every euphoric expansion ends in brutal drawdowns. Bitcoin retraces 60 to 70%. Altcoins collapse 90 to 95%. If you haven't visualized your portfolio under those conditions, you are already overexposed. You should already imagine and fully internalize the fact that most of your coins are going to go down a lot at some point. So you have to be mentally prepared. You have to detach your identity from your gains. Unrealized gains creates false ego. When the market reverses, the ego resists selling because it feels like self-destruction. You must view your P&L as numbers. It's not validation. And the pain creates opportunity, like we've said before. So the goal is simple. Survive long enough to deploy capital when everyone else has given up, because this is the maximum point of opportunity. Rules before regret. Retail lies to themselves. They tell themselves they know how to sell, but they never do. Most of the time, their targets are too high, and price doesn't even get there. They haven't accounted for the possibility that prices might not reach their targets. Good traders remove the choice by creating rules in advance, scaling profits, alerts, and accountability structures. So, this was the chart in 2021, 2022 bear market, monthly chart on Bitcoin. This was a minus 76% dump on Bitcoin for the bear market, and similar is going to happen in the next bear market too. So, cycle endgame checklist, position and reality check. Stress test your portfolio. If majors dropped 70% and alts 90%, would you survive? If not, you're probably overexposed. Stablecoin ammunition. Rotate a defined percentage into stables. Capital preserved now multiplies in the bear. You have to remember to take profits, guys. Exit into strength. Scale out while momentum is still high. Don't wait for the top to be confirmed, as it never is confirmed. Narrative rotation discipline. Hunt narratives early, ride them hard, and rotate out as they hit large adoption. Risk scaling. Increase defense as the cycle gets closer to the end. Tighter risk management, smaller position sizes, higher cash reserves. Psychological conditioning. Review past cycles, detach identity from P&L, and anchor yourself in rules, not emotion. And the battlefield mindset. Treat the final innings of the bull market as a war. The goal is not to win every single trade, but to exit solvent, liquid, and armed for the next cycle. Have a lovely day, guys. Bye-bye.